Hello, everybody. Welcome to Managerial Accounting. This is absorption or traditional costing versus variable costing. This is my overview. So when we're looking at an absorption costing income statement, this is the traditional one that we've been studying all along in for financial accounting. You have your sales less your cost of goods sold is going to give you your gross profit. Less selling, general, and administrative expenses is going to give you your net income under what we call absorption costing. Variable costing is our sales minus our variable costs, gives us our contribution margin, minus our fixed costs are going to give us our net income under variable costing. And this is what we studied in the last series with cost, volume, profit. Now, the biggest difference between these two methods is fixed factory overhead. The reason why is that our fixed costs, especially the fixed factory overhead, is being immediately expensed under variable costing. Here, our cost of goods sold by definition are going to include those fixed factory overhead costs. So under absorption costing, when we look at our ending inventory, that fixed factory overhead is going to be lingering in there. So as we go through and look at all of the different examples we're going to be doing, what I want you to be thinking in the back of your mind is when we're ever doing an income statement under either method, the difference is going to be fixed factory overhead. Now, in terms of the cost per unit, what's the same? Direct materials, direct labor, and variable overhead. In a variable costing income statement, these are all a part of the variable costs of goods sold. And that is going to be the same as under absorption. Okay, so, but the big difference is for fixed factory overhead, that becomes a part of the absorption cost per unit. But under variable, just remember, it's being expensed immediately. So when you're looking at, depending if it's going to be higher or lower, when we're looking at net income, it's all going to depend on if we have a beginning or an ending inventory. So variable costing might actually give us a better picture. The reason is that if we're kind of going under the theory that fixed costs can never be changed, they should really be expensed immediately. The other part of this is that this is kind of like an accounting after dark, but under absorption costing, because my fixed factory overhead is potentially going to be spread out amongst more units, if I overproduce inventory, I can lessen my fixed factory overhead cost per unit, and therefore I can achieve higher gross profit. But there is a problem with the overproduction of inventory. So using these variable costing income statements can be very, very powerful for us in terms of getting a better picture as far as how we're going through and doing. So we're going to be doing a lot of examples. So we're going to do variable versus absorption, same units being produced and sold, no beginning inventory, but an ending inventory, beginning inventory, but without an ending inventory, beginning and ending inventory under FIFO, which is first in, first out, beginning and ending inventory under LIFO, which is last in, first out, converting variable costing to absorption costing, and converting absorption to variable costing. So those are the different examples we're going to be going through and looking at. Again, my philosophy on these chapters is to really go through and do the work. We have to go through and do the income statements, and then we'll see where we go to next. But anyways, I want to thank you for joining me here today. If you have any questions, please feel free to leave them below, and appreciate you liking and subscribing to the channel. I look forward to seeing you on the next video. Have a great day.